Good morning and good afternoon to everyone on the line. It's great to have so many dialed in for the webinar today. I think we have about 100 registrations, so that's great to see a very good turnout. As a quick introduction, my name is Simon Henry. I'm the Program Director for the International Carbon Reduction and Offset Alliance, or ICROA. We are the voluntary carbon market part of IETA, the International Emissions Trading Association. So we are the business association for the voluntary carbon market, and we're made up of some of the leading service providers in the voluntary market. As a business association, we provide a number of services, including a form of self-regulation. So we have a code of best practice for carbon management, and all our members sign up to that code and are audited against it, and that helps them differentiate and stand out from their competitors in the voluntary market. So moving on to today's webinar, I'm going to thank Kelley for providing the webinar today and presenting the results of the new report on the state of the voluntary carbon market. I know the report is always important to our members. It helps to provide a good overview of the market, and our members always look forward to its publication coming out around this time every year. To help reiterate some of the messages in the report, ICROA has actually recently published some analysis looking at retirement volumes in the voluntary market. And that analysis showed that volumes are close to the record highs that we saw last year. So we're very optimistic about the future of the voluntary market and the business that it's generating. And if you're interested to see more about that analysis, you can go to the news section of ICROA's website, icroa.org, where you'll find some further details. I know that some of you may also have seen the press release that we put out regarding that analysis last Thursday. So I'm now going to hand over to Kelley, and Kelley's going to run us through the highlights from this year's State of the Voluntary Carbon Market report. So over to you, Kelley.
Perfect. Thank you, Simon. A quick note before I begin. So I'll be presenting the results of the latest report in the next 15 to 20 minutes, and then I'll be followed by two panelists who will give us a bit of sort of more actual market and on-the-ground perspectives. But if you have any questions throughout that time, you should be able to just enter in questions in the question box, and then we will have time for Q&A at the end of this webinar. So once again, thank you, Simon, for your introduction. And welcome everybody who is dialing in right now to the launch of the State of the Voluntary Carbon Markets 2017 report. Before we begin, I'd like to thank and recognize the following organizations: our sponsors, the Biocarbon Fund, Biocarbon Partners, Numerco, and Good Energies, and our supporters, the American Carbon Registry, the Verified Carbon Standard, the Climate Trust, and Baker & McKenzie. All ecosystem marketplace reports are freely available on our website, and it's really thanks to organizations like these who support our work. So in case you aren't familiar with Ecosystem Marketplace, we are an information provider about, of course, ecosystem markets. We produce reports, newsletters, and articles about activity in these areas, and the State of the Voluntary Carbon Markets is our longest running and perhaps best known report. So to collect data for this report, we email and cold call over 1,000 organizations that we think are active in this space. So data for this year's report comes from 231 organizations who responded, of which 140 provided us with voluntary carbon offset transaction data for 2016. One caveat is, of course, despite our best efforts to collect 100% of voluntary offset transactions for the previous year, we know that we don't ever capture everyone's response. So organizations that responded in 2015 but did not respond this year transacted about 10 million tons of offsets in 2015. Of course, on the flip side, we also had many new organizations report new transaction volumes in 2016 who did not report in 2015. So finally, one more quick note about our methodology before I dive into the findings. This is sometimes, I think, a source of confusion. So we track transactions, which we define as the point of contract at which an offset changes hands. So this means that a single offset could be involved in multiple transactions before being purchased by the end buyer. So you can see in this figure here, It could be that an offset is sold from a project developer to a retailer, and we would count that as one transaction. And then that same offset could then be sold from a retailer to an end user. We would count that as another transaction. So offsets sold from project developers are considered to be part of the primary market, and those sold by brokers, retailers, or other intermediaries are considered to be part of the secondary market. And those are terms that I will use sort of throughout the rest of the presentation. So on to the results. What did we track last year? So this chart shows the historical volume tracked, and as you can see by the dotted red line, we recorded over 1 billion offsets transacted this past year, and this is cumulative since we first started tracking these markets in 2005. In 2016 alone, we tracked a total of 63.4 million tons transacted, a 24% decrease compared to 2015. However, we don't see this as particularly alarming. As you can see in the chart, the markets are always variable to some extent every year. And a few other possible factors include that, as I mentioned before, we had some respondents not provide data this year. So in particular, there were 2 large ones that last year reported 5 million tons who didn't respond this year. But also just within respondents, large respondents who did respond this year and have reported in the past, I followed up with some of them who reported lower volumes, and many of them said that this was not indicative of a trend. It's just that some buyers don't purchase offsets every year, and so they expect sales will increase more in 2017. So this is a very similar chart. This is showing historical value tracked across all years. And unsurprisingly, we also tracked a lower total value of offsets transacted in 2016. The total was $191.3 million. And the main reason for this low market value is just the corresponding lower volumes that were transacted last year. The average price paid for offsets actually remained relatively stable. That was at $3 per ton. And if you split this between the primary and secondary markets, you see a little bit of difference with the volume and average price and how that affects value. So on the primary market, the average price was $4.1 per ton. And on the secondary markets, the overall average was $2.4 per ton. But the secondary market volume was more than double of that than on the primary market. So I wanted to explain a little bit about what do I even mean when I'm talking about average price. So the actual prices that we track in the survey are highly variable. Some of the actual prices range from less than 50 cents per ton to more than $50 per ton. And they differ based on a number of different elements. It could be because of the offset project location, the standard, the project type, or a number of other attributes. So this figure shows the average price for some of these different attributes sort of split out. So for example, to the far left, the dark blue column on the far left shows the lowest average price of hydro, that was with hydropower projects. And then on the far right, so there are 2 average project locations, sort of on the higher end and the far right, and that shows the average prices for Ethiopia and Canada. So this is really just, this figure is just to show that there's a lot of different ways that you can consider the average and that you can sort of view these different averages under different lenses. But even within these different categories, there's still a lot of price variability. So for example, clean cookstove offsets from Asia and Africa transacted at an average of $2.9 per ton and $5.1 per ton, respectively, between the both continents. But the actual price range, not the average, but the actual prices range from below $2 per ton to almost $20 per ton on both continents. So all this to say, there are a number of factors that can really affect average price. We're going to touch on some of these in more detail in the coming slides, but one thing I wanted to highlight that is also influential is the transaction size. So this chart shows the total offsets transacted in different price ranges. So in general, we saw large transactions have a lower average price. So in 2016, over 17.3 million tons of offsets were transacted at less than $1 a ton. Within that, the majority, or 93% of those, were transacted on the secondary market, which you can see that's the light blue shown in the figure. And in contrast, we tracked 2.4 million tons sold at an average price of $10 or more, and 47% of those offsets transacted were on the primary market. And one of the things that I thought was a little interesting here that I wanted to call out is if you take a look at the maroon bubbles, that shows the actual number of transactions. And so you can see that while the total volume transacted at more than $12 a ton was significantly smaller than the total volume transacted at less than $1 a ton, the number of transactions was pretty similar. And this just indicates that there are quite a few deals happening at very high prices, but that buyers really tend to purchase those offsets in much smaller quantities. So in the next two slides, I'll be zooming in on some of the different offset attributes that were valued in the market last year. So this figure shows project category. So basically in the survey, we'll ask organizations to say, when they're reporting about offset transactions, to say what type of project type was associated with those offsets. And we have, I think, over 30 different project types, and so I've rolled them up into 8 broad categories that are listed here. And while this figure shows information by project category, in the report we do have figures that actually do break down some of this information by project type. And a quick note about project type. Project types can really appeal to buyers in a few different ways. Some buyers we see want to support project types that have strong associated co-benefits, such as habitat protection or job creation. Meanwhile, other buyers really just want to support project types that are easy to understand or easy to explain. So as you can see here, the 2 largest categories that we tracked last year were in renewables and forestry and land use. We tracked 18.3 million tons of renewable offsets transacted and 13.1 million tons of forestry and land use offsets transacted in 2016. There is, however, a fair difference between the average price. So renewable offsets sold at an average of $1.4 per ton compared to forestry's $5.1 per ton. So as a result, the value of forestry and land use offsets was nearly triple that of the renewables and comprised 47% of the total value that we tracked across the entire voluntary carbon markets. And then a brief note on the main project types. The 5 most transacted project types by volume in 2016 were RED Plus, which is within forestry, wind, landfill methane, large hydropower, and community-focused energy efficiency projects. And on average, the lowest average price project types were from large hydro and transportation projects, and those were around 20 and 30 cents per ton. And the highest average project types were improved forest management at $9.5 per ton and afforestation reforestation projects at $8.1 per ton. So this figure shows the location of offsets sold worldwide. It may be difficult to read the text, but you should really just focus on the colors here. So countries that originated more offsets that were transacted last year are shown in dark blue, followed by light blue color, then dark green, and so on. So voluntary projects are often motivated to choose certain locations for reasons sometimes beyond emissions reductions potential. So for example, many forest carbon projects aim to protect trees and biodiversity first and foremost, and carbon is sort of one means to achieve forest protection. So all this to say that the location of projects is often chosen at a subnational level and is highly specific to certain communities or ecosystems. Unfortunately, with the scope of our report, we don't track that detailed of information, but we do track it at the country level. So in 2016, we tracked projects in 65 countries that produced and sold carbon offsets on the voluntary market, which represents every major region of the world except for Antarctica. The majority of offsets were transacted from Asia. We tracked 21.5 million tons sold, most of which came from India, Korea, and China. And while nearly half of all offsets came from Asia, buyers placed a higher value on offsets from Africa, Latin America, and North America typically. So within North America, that was the location generating the second largest number of offsets transacted for a total of 10.1 million tons and a total value of $29 million. And meanwhile, offsets transacted from Latin America and Africa totaled 5.8 million tons each and represented total values of $22 million for Latin America and $24 million for Africa. Meanwhile, Oceania sold the fewest offsets on the voluntary carbon markets. It was a little over 500,000, and most of that came from Australia. So when we first started tracking voluntary markets in 2005, many projects did not use a third-party standard. That has changed quite significantly. In 2016, 99% of all offsets transacted were certified by a third-party standard. And while respondents reported using 13 different standards, most offsets were transacted under sort of a handful of very familiar standards. So the verified carbon standard, we tracked 35 million tons that were certified under VCS, which represents 58% of the total offsets transacted in 2016. Of those, 7.7 million tons were also certified by the Climate, Community, and Biodiversity Standards, which focuses on social and environmental co-benefits of land-based projects, but it doesn't actually issue emissions reduction credits. Other common standards were the gold standard, which captured 17% of total volume on the market, and then both the Clean Development Mechanism and Climate Action Reserve had 8% respectively of the market. And then finally, the American Carbon Registry made up 3% of the total volume sold on the market. And then after that, there are some sort of smaller standards. Many of those have a focus on a particular country or project type. So for example, Plan Vivo, which certified 0.6% of offsets traded in 2016, only focuses really on community, land use, and forestry projects. But then because of that, they had higher average price of $8 per ton because as I mentioned in one or two slides ago, typically afforestation, reforestation, and improved forest management projects were gaining higher averages. So far, I focused on transactional trends, but we also asked respondents about offsets that remained unsold in their portfolio. So as you can see here, respondents reported transacting 63 million tons of offsets last year, but quite substantial amount, 56 million tons, still remains available for sale within their portfolios. The reasons for this varied, but almost half of unsold offsets were because the respondents simply couldn't find a buyer by the year's end. Another 1/3 were waiting to sell their offsets until they could find a better price. And then some of the other reasons were, waiting for better contract terms or an expansion of the market. We also asked this year organizations if they plan to continue their current carbon offsetting operations in the future, and whether or not they plan to increase that or decrease that. So 28 organizations responded to that question, and the answers were split fairly evenly. 11 said that they plan to increase their offsetting activity in the future. 4 said that they plan to maintain their current focus on offsetting, and 11 said they plan to decrease their participation in the future. And for those that were planning to lessen their engagement in voluntary markets, organizations reported prioritizing some of the following over voluntary carbon activity, which included entering other environmental commodity markets, such as the renewable energy certificate market, or expanding to focus on consulting or advising organizations on topics such as sustainable forestry or biodiversity. Finally, we asked respondents about what trends or developments they are keeping an eye on, and perhaps unsurprisingly, many mentioned following the politics around climate change, particularly in the United States, and they expressed hope that corporations and others might step up to address climate change following the current administration's failure to do so. And then other than that, many of the other topics are sort of familiar with those who are active in these markets. A lot of participants to the survey said that they're still keeping an eye on the aviation. So the airlines are creating their own carbon offsetting scheme known as CORSIA, stands for Carbon Offsetting and Reduction Scheme for International Aviation. Which offsets will be allowed in this market still it remains to be negotiated, but that could influence opportunities for voluntary market participants perhaps to find a new source of demand there in the future. Meanwhile, corporations continue to make commitments around science-based targets, which is having emissions reductions really based in line of keeping emissions reductions below 2-degree rise. And while many of these commitments don't explicitly mention offsetting, it seems likely that offsets might be used perhaps by these companies once they've taken other measures to reduce their carbon footprint. Similarly, there are companies making commitments to reduce deforestation from their supply chain around key commodities like palm oil, timber, soy, or other key commodities. And we see that there might be some potential there for some overlap, perhaps with some forestry offset projects that are also sort of trying to seek to reduce or avoid deforestation. Also reported last year in our last year's report, but we're also keeping an eye on this year, the Greenhouse Gas Protocol Corporation Standard revised key guidance around company reporting of emissions reductions back in 2015. And one of the changes basically allows companies to subtract renewable energy gained from renewable energy certificates from their reporting, but it did not allow for renewable energy offsets to play a similar role. So that's led some market participants to believe that there might be a shift in demand from carbon offsets in favor of renewable energy certificates. And then finally, of course, the big one that everyone has their eye on is what happens after the Paris Agreement, what would be negotiated about the role of offsets. This could obviously have huge implications for voluntary offsetting. We actually asked a couple of more in-depth questions on this particular topic in our survey, and these are listed in the report. But we asked participants in particular about what they saw as potential risks and opportunities for voluntary offsetting. And the majority of respondents cited national policies around counting emissions reductions as the biggest risk towards future voluntary offsetting activity. So for example, if a country decides they want to keep all emissions reductions towards their own domestic commitment, then they might not allow voluntary market participants to sell offsets abroad. Conversely, despite the risks, I think everyone in this market is always a bit of an opportunist at heart, and respondents saw clear avenues for selling more offsets in the future, especially if a future global market might allow for the transfer of voluntary offsets. If voluntary offsets couldn't find a home in a new global market, participants thought that there might be opportunities in specific sectors, so for example, like aviation. And even if all of those avenues were closed, respondents still thought that there might be corporations that would want to support voluntary offset projects in order to help their home countries meet their emissions reduction goals, or that there might also be companies interested in supporting projects simply for their non-carbon benefits. So with that, I'd like to turn to the panelists. I did have one more comment, which is just to say this year we tried to shorten the report to make it a little bit more readable, but as a consequence we took out a few sections. We'll still share that data with everyone. We're going to have two sort of mini reports coming out in a month or two. One will look at regional voluntary offsetting market trends and policies. The other will look at issuance and retirements data along with motivations of voluntary offset buyers. So those will be two mini reports coming out in a month or two. But with that, I am done talking for now. I'd like to switch it over to Dr. Hassan Sachedina, who will share with us some of his experience working on RED in Zambia. Let me change.
Right, great, thank you.
There you go.
Okay. All right. I'm just gonna turn this into a slideshow. Good afternoon, everyone. My name is Hassan Sachidina, and I run a company called BCP. I'm based in the Luangwa Valley of Zambia, and I just wanted to do two things today. One of which is share some of our experiences from the sort of proverbial front line. And the second thing that I was asked to do was to share some of the things from the State of the Voluntary Carbon Markets report that resonated with us. So just to start off with, BCP is an African-based and majority African citizen-owned forest offset development company. We're headquartered in Africa as well. We're a social enterprise. We're mission-driven company, and our mission is to make forest conservation valuable to people. We have approximately 150 staff, of whom 98% are African-born. And our vision is to empower communities conserving Africa's greatest forest and wildlife strongholds. So we're very much driven by locations. We're not interested in working in any forest. We're really interested in working in forests which have global biodiversity significance. So we've got two phases here. We have a project called the Lower Zambezi Red Plus project. It's roughly 39,000 hectares and it borders Lower Zambezi National Park in Zambia. And that project has been verified 3 times. It looks like it's about to be verified for the 4th time to VCS. And it's been validated to CCB to what's informally referred to as triple gold, outstanding benefits, in terms of climate, biodiversity, and community. And the CCB verification is planned in early 2018. We're currently working on a phase 2, which is called the Luangwa Community Forest Project. And it's a pretty major scale up of about 20 times. And it's about 740,000 hectares of conserved forest. And this is the map that you see on the right. The Luangwa Community Forest Project essentially is working with communities and government in these areas in and around 4 national parks. So Lower Zambezi, South Luangwa National Park, Luambe, and Lukusuzi. So the areas which we are working in partnership with communities and government are areas which are either corridors or dispersal areas for wildlife or buffer zones between these national parks. I'll come back to this slide. So the Luangwa Community Forest Project is being funded through a $14 million grant from USAID. And it's presently Zambia's largest RED effort. It's targeting up to 2 million tons per year in terms of forest carbon offsets. And in terms of community impacts, we're targeting 60,000 people, 10,000 households positively impacted, benefiting by the end of 2017. This area, from a conservation perspective, it's one of the last great strongholds in Africa from a variety of different angles, from predators to elephant, endemic species, as well as locally rare species. And some of the key livelihoods and enterprises which I'll share more info on include a sustainable charcoal initiative, which we call Eco Charcoal, honey, wildlife-based tourism, and conservation farming or climate-smart agriculture. The Lower Zambezi Red Plus project, it was the first project in Africa to be VCS verified and achieve CCB triple gold. The project is quite close to the capital city, so it experiences significantly high levels of deforestation, even compared to the Zambian national average. it generates an average of 200,000 tons of offsets per year, and over the 30-year lifespan of the project is projected to offset 5.5 million metric tons. In terms of sales, the project has not done badly. I mean, we have 67,000 tons which are issued, but and still in stock. So, the project has done quite well. We've sold roughly 90% of what was issued since the initial verification. We're working with 1,200 households, and that's 8,300 people. The community benefits in this project are significant because the project's been running for about 5 years. And so in terms of cumulative investment from water, conservation agriculture, honey, it's quite significant. And I'll get into some more detail on that. In terms of high conservation value species, you're looking at sable, roan, wild dog, lion move through the area. And this bird on the right is a southern ground hornbill, which is IUCN red listed as vulnerable. And the forest within this project, an area called Rufunsa Conservancy, has quite a high number of viable breeding families, groups of the southern ground hornbill. So the maps on the right, I'd like to give credit to the Zambian Carnival program. What they show is South Luangwa National Park, Luambe and Lukusuzi. And the red is land use change, deforestation in 1972. If you look at 2011, the amount of deforestation moving towards the national parks and the game management areas, there's quite a significant change. Between 2011 to 2017, you can imagine that the red on both sides of the river, the valley, are moving more and more towards the national park boundaries. If you look at Lukusuzi, there's a hard boundary on its eastern flank already. According to Zambian national data and the UN as well, Zambia has the highest amount of deforestation by land cover of any African country per year. It's roughly about 279,000 hectares is lost in Zambia. It, I think, puts it in approximately the global top 5 in terms of land cover, losses from deforestation, and puts Zambia in the global top 10 of per capita emissions from deforestation. So there's clear and present threat in these forests, as you can see. The Luangwa to Lower Zambezi ecosystem is one of the last great wilderness areas on Earth, not just in Africa, but it's facing serious deforestation threats. Our RED model is similar to other operators, developers. You have a site management. I'll go clockwise. Site management, which involves security, land management, biodiversity monitoring. The land management includes things like fire, infrastructure development, communications, radios. Community development, so the livelihoods and enterprise development project, we place a fairly heavy emphasis on this to try and get the incentive package right. The way we measure this is, do we have deforestation in the conservation forests or not? And in the Lower Zambezi RED Plus project, there is zero deforestation. We invest heavily in social services, education programs, infrastructure, and governance. So at a local level, we partner either with community cooperatives or what are referred to in Zambia as community resource boards. And we help to support the governance of these institutions so that they can help with local level implementation. We've got, these projects need quite a heavy level of support in terms of finance and admin, procurement, IT, and compliance, legal, government, for example. Of course, you need a sales and marketing capacity, and the carbon accounting is obviously central in terms of the GIS and forest monitoring. So we're targeting annual VCS verification and every 5 years a CCB verification. We prioritize community engagement. and it shows up in our community impacts. Our current beneficiaries that we've quantified, we are about 22,000 people, about 3,700 households. Our 2017 target, as I mentioned, is 60,000 people. And we're investing on average about $475,000 directly into the communities per year. And that's broken down into livelihood activities and conservation fees, and of course employment. About 68% of our payroll is into directly communities, so communities which are, you know, historically lower income. If you take this photo on the right, some of the community impacts, like around clean water, around the Lower Zambezi Red Plus project, in the project zone, approximately 67% of all the clean water in the entire area has been either drilled or rehabilitated by BCP. It's quite an astounding metric. We're not aware of many organizations in Zambia or other places which can, you know, which have generated, you know, this amount of fresh water in a particular area. And this all comes from forest conservation. In terms of the conservation enterprises which are being used as a strategy, leakage mitigation, job creation, and also creating alternatives. On the left, eco-charcoal. So this is now supplying supermarkets and the wholesale market in primarily Lusaka. Lusaka's annual charcoal demand is estimated at roughly 40,000 tons, the majority of which is produced unsustainably and does not pay taxes. This eco-charcoal is produced sustainably through sustainable forest management, improved kilns, and also pays, you know, all the different taxes. It's basically a model where we pull unsustainable charcoalers into a model where they get paid more and produce charcoal that results in forest remaining forest over the long term. We are also investing heavily in honey production. So overlaying these conservation forests and even these eco-charcoal forests with apiaries. And we are targeting in the Lower Zambezi Red Plus project, there's 6,000 hives which are rolling out this year. And we've got a plan to roll out to, in the Luangwa Community Forest Project, we've already subcontracted for this to go up to, I think, 25,000 hives over the next 2 years. In terms of conservation impacts, we're looking at habitat protection. Essentially in these corridors linking two trans-frontier conservation areas, Lower Zambezi Mana and Luangwa Nyika. So it's linking 5 countries, Malawi, Zambia, Mozambique, Zimbabwe, and Zambia. And this is all being done in partnership with community resource boards and government. We are noting wildlife increases in the Lower Zambezi Red Plus project since we started and now, pretty significant ones of things like species like sable, roan, even lion. And we're doing biodiversity monitoring in partnership with organizations like Lion Landscapes. We have achieved zero deforestation in the Lower Zambezi Red Plus project, and we support approximately 4,000 conservation mandates per year, and that's steadily increasing as we roll out into these Luangwa conservation community forest project areas. In terms of the risks, you know, President Trump's statement, I think it shocked us all, but you know, what we're worried about is, you know, what is that going to do to companies who are thinking of dipping a toe in, who might pull back and wait and see. A large amount of our budgets, our startup budgets, are being funded by the Presidential Global Climate Change Initiative at USAID. We anticipate that's going to be cut to zero in future, so not our existing budget. We're optimistic those won't be touched, but anything moving forward, we anticipate GCC is going to be gone. It's really important, I think, you know, for us to look at a mechanism like Corsia or the Green Climate Fund or California, some kind of meaningful offtake market to instill more confidence into, for example, RED. Zambia is one of the countries which has been selected by the World Bank, I think one of 3 by the Biocarbon Fund, for a 10-year emissions reduction purchase agreement. It's called ZIFOP under the ISFL. This is a really positive development because it basically overlays with that map that I showed you, which is primarily in the eastern province of Zambia. However, one of the risks is that the national policy environment in Zambia is, and how this ZIFOP will be implemented is still yet to be designed. So it's still a little bit unclear yet in terms of the role of developers like us, but we remain optimistic. As we get through our verifications, it's concerning to us the price drop on older vintages. And one of the other issues as well, if you look at this photo on the right, is one of the risks and the complexity of implementing these projects in rural Africa, the risks around local governance and opportunity costs. Illegal logging is, we saw a report recently that it eclipses the illegal wildlife trade. And we're seeing a lot of pressure from illegal logging. For example, in Zambia, the charcoal market is huge. It's a $200 million a year business. And local governments who may have entered into agreements with a red project developer, when they get approached by entities who want to go in and cut those forests, the opportunity cost of risk is quite high. In terms of some of the key points from the report which resonated, one of the things was a statement, in terms of it's really important that we try to reverse emissions to 350 parts per million. I think I saw a report recently that Mauna Loa reported that it was up to 415 parts per million. So getting back down to 350 is ambitious. It is going to need a huge infusion, of capital, especially, globally into the different sectors, but also into forest conservation. The other thing that was alarming to note, and I'm glad that Kelley touched upon it and gave some more context, was a 24% drop in volume from 2015 to 2016. It was also interesting to note the very wide variation in pricing from 50 cents to $50 a ton. And this average price of $3, with an average price of 4.2 for red, but it was encouraging to see that red was the most transacted. Our average pricing, I'm happy to say that has been a bit higher than this $4.2 per ton, but the pricing pressure has been going down if we look at the State of the Voluntary Carbon Market report over the last few years. So thank you very much, and here are my contact details.
Great, thank you so much, Hassan. I'm going to now change the presenter to Brian McFarland from the carbonfund.org, and also he's project originator, director of Carbon Co., which I'm sure he might explain as well. And let me, okay, over to you, Brian. Oh,
hello,
sorry.
everyone. My name is, hi, can you hear me, Kelley?
Yeah, I can, sorry.
Okay, perfect, no problem. Hi, everyone. My name is Brian McFarland. It is an honor to be invited back to share my thoughts on this year's report. I'd like to start by saying thank you to Kelley and her team for compiling all the data and producing this year's report, along with a thank you to all your sponsors who have made this possible. I read the report every year. Not only do we contribute data every year, but I pass along the report to my colleagues and to others interested in our industry, such as graduate students or those with possible new project ideas. I find the report very, very helpful, so thank you very much for all that you do. For those of you who may be unfamiliar with carbonfund.org Foundation and Carbon Co., I will give just a brief background on who we are, the projects we support, who supports our work, before sharing some of my thoughts on this year's report. So carbonfund.org Foundation was founded back in 2003 as a 501c3 not-for-profit corporation. What this means is that at our core, we are an education nonprofit. So my colleagues and I will do a whole bunch of education and outreach to individuals and businesses, generally about climate change, and more specifically about the greenhouse gas emissions that individuals and businesses are responsible for. So we'll help these individuals and businesses identify areas to reduce their energy usage, areas to adopt more efficient modes of transportation. We work with companies on their sustainability plans. And then ideally, these individuals and businesses will choose to offset a portion or all of their residual emissions by donating to carbonfund.org. And then we support third-party projects in the energy efficiency, renewable energy, and forestry sector. In essence, carbonfund.org is a classic carbon offset retailer, and historically we did some project development, but those responsibilities have now been transitioned over to our subsidiary, Carbon Co. Historically, we've worked with approximately 750,000, probably closer to 800,000 individuals, and we've partnered with more than 2,000 business partners. The majority of these business partners are honestly smaller companies, but we do have several dozen Fortune 500 partners that have supported our work. And with all of these partners' support, we have been able to finance more than 70 carbon reduction projects throughout the United States and in about 15 to 20 different countries. And then back in 2011, carbonfund.org created its wholly owned subsidiary, Carbon Co. LLC. Now, as my role of director of carbonfund.org's project portfolio and the director of Carbon Co.'s project origination, I see the market from both a buyer and a seller's perspective, as well as from a finance and policy perspective. Here's just a quick visual of some of the larger partners of carbonfund.org and Carbon Co. that tend to be concentrated in the consumer electronics and transportation sectors. Carbonfund.org's project portfolio is quite diverse. We have supported a wide variety of energy efficiency projects, a wide variety of renewable energy projects, including wind projects throughout Middle America and in China. We've supported a lot of livestock methane and landfill gas energy projects throughout the United States, including particularly the Northeast. We've supported a lot of forestry projects, including reforestation projects in Panama and Nicaragua, as well as truck stop electrification projects and solar projects as well. Carbon Co., in contrast, provides some consulting engagements, but we really have a more narrow focus, and that is the project development of RED projects in Brazil. Carbon Co. traditionally has provided the upfront financing as well as the technical expertise when it comes to project development to get 4 large-scale RED projects in the state of Acre through the validation and verification process. And these 4 projects are projected to reduce a little more than 16 million tons of carbon dioxide equivalent emissions over the project's first 10 years. They're conserving approximately 300,000 hectares of lowland tropical rainforest and are helping approximately 600 local people with a wide variety of social programs and projects, including building health clinics, facilitating doctor and dentist visits. We are granting lots of land titles and offering free agricultural courses. Now, just a few quick thoughts so we can have a little time for Q&A. Last summer, my colleagues and I did a detailed business plan for both carbonfund.org and Carbon Co. And as part of this business plan, we did a global and regional analysis of the carbon markets, looking specifically at RED. We did an industry analysis, including mapping our various competitors. We did a SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats. And we ran all sorts of financial numbers for 2011 to mid-2016, looking at the donations we received from individuals versus businesses, the different project types that were chosen, looking at those donations that went towards offsets versus RECs versus general support. And from this analysis, I can say that we share a lot of the same common trends that have been identified in not only this year's reports, but in previous reports. So first, forestry has historically been and remains our most popular project type. This is followed by renewable energy, particularly landfill gas energy and wind projects. Our retail price remains $10 per offset. We are flexible with our pricing, particularly with our largest donors. We see a wide range of prices, but unfortunately there is this downward trend of prices that we have witnessed, much as all of you have as well. From 2011 to 2013, we saw our donations go down. Starting in 2013 up to 2015, our donations have increased. Our 2016 audit is almost complete. so those numbers are not yet final, but I expect 2016 to look fairly similar to 2015. Much like all of you, our donors prefer newer offsets. I did really like the analogy of the voluntary carbon markets being comparable to the real estate markets. Our donors definitely like to choose projects based off location, much as real estate markets work. When it comes to offsets that have not been sold at the end of the year, again, reflected in the report, we have offsets that are unsold because either there's a lack of buyers or the price is just simply too low for us to part ways with our offsets. We also share a lot of the same risks and opportunities. There are various policy risks that we experience. From a project developer's perspective, due to the decreasing demand and decreasing prices, there is a challenge of increasing requirements for our projects, whether this is the required use of templates, the need to start incorporating sustainable development goals, the need to provide upfront payment for CCP verification, or the mandatory auditor changes. They just present some additional requirements that, that make it a little bit more difficult on our projects. But that said, we're watching the same developments as everybody else. We're very excited about Corsia. We definitely have scalability in our projects, so we are sort of waiting and seeing and following the policies as closely as possible. A few other thoughts. I thought it was fairly promising to see that 5% of the contracted VERs were for post-2016 vintage. In the past, we've had some multi-year VERPAs, and I just can't stress enough how helpful these structures have been for our projects. With respect to the discussion in the report about inventory supply and offsets remaining in one's portfolio, I don't know, but I'm thinking if the supply was actually less, I don't know if prices would necessarily go up like a traditional market, or if these voluntary buyers would abandon their commitments. But that said, I am definitely an optimist. On a more positive note, we have seen an uptick in our donations since last year's U.S. election. We see a lot of promise in jurisdictional red. We're working very closely with the state of Acre, which is seen as one of the leading jurisdictions when it comes to jurisdictional red. And whereas last year only, quote unquote, $200 million worth of offsets were transacted, there's a lot of different ways to view things. And I would say that while it is only $200 million and we need a significant more amount of money for these projects and to combat global climate change, $200 million is still a significant amount of money considering these individuals and businesses are under zero legal obligation to support our projects. So that said, I will turn it back over to Kelley. I am more than happy to answer any questions either now or in the future. So thank you for joining today's webinar and thanks for listening.
Perfect. Thank you so much, Brian. Let me switch back to show my screen. So yeah, thank you again for Simon and Hassan and Brian to share their thoughts. I do want to switch over to questions really quickly. Basically, you know, if we don't get to all of your questions, I will be able to send these questions on to all of the panelists. So please do write questions into the box there. But perhaps just to start with, I'll just go in order. The first question was just, will this presentation be available after the webinar? The answer is yes. We will. I'm recording this right now, and we will make the recording available online probably in a week, I would say. But then the next question was, can you mention some difference between offset vintages and also in terms of prices? So I don't know, Hassan or Brian, if you want to take the first stab at this question of your experiences.
Sure, I don't mind. I mean, I guess just sort of real briefly, we definitely see from both a buyer's and a seller's perspective lower prices for older vintages, which I think a lot of companies and individuals want to match up the vintage of the offset with the year, the emissions their sort of businesses or everyday lives were emitted in. But that said, I do feel as though older vintages are just as valuable as the newer vintages In fact, one could argue that the older vintages are even more valuable because those were the sort of initial offsets that were generated to bring in initial financing for the projects and to get them sort of on their way. So, I mean, personally, I'm sort of agnostic to the different offsets, but our donors and what we see in the market is definitely a preference for newer offsets, and those come with higher prices.
In our experience, it's true, sort of 2010, 2011 vintages, the pricing pressure is down to, almost the $2 a ton mark, which is, practically unsustainable, for us. But for newer vintages, we're looking at, for bulk pricing, around that $6 mark. It's interesting. There are some sectors which are agnostic. I agree with what Brian was saying in terms of, the older vintages, they've sequestered, they've kept that emissions reduction out of the system for longer. But it's interesting, this sort of preference that buyers have for new. But some sectors, we found, like, for example, the tourism sector, agnostic. They're happy to pay up to $12 a ton, small transactions. But, for older vintages, it's more the neutrality that counts to them.
Great. And moving on to the next question, it's written for me, but I think I might also pull Simon in unsuspectingly. The question is, how has the voluntary market considered the possibility of countries or states to still be engaged in voluntary markets or allow project levels to be engaged with markets without undermining their national capacity to determine achievement of their national targets or emissions reductions under their indices, and indices stand for nationally determined contributions. I mean, so basically, I think the issue right now is just that my sense is that a lot of people in the voluntary markets are trying to figure out how they might fit within countries' national commitments, but no one really, no one actually has any answers. I think there's a lot of just thoughts about maybe what should be done or what might be done. But the reason I wanted to maybe call on Simon really briefly is that he actually headed a workshop 2 weeks ago that was actually on this question exactly of, what role is there for voluntary offsetting post-2020. So I know what I presented was what some of our survey respondents sort of thought about these opportunities and risks, but Simon, maybe you have a couple of comments from that workshop.
Yeah, thanks, Kelley. Yeah, that's correct. So ICROA hosted a workshop at Innovate for Climate 2 weeks ago in Barcelona. That's what used to be Carbon Expo. So we had about 70 participants at that workshop, which was largely a brainstorming session on exactly this topic, the post-Paris world, and how do we secure a role for voluntary action in a post-Paris world. And we, on the one hand, we're very optimistic on the future of the voluntary market. We're all aware of that the NDCs lack ambition to deliver the 2-degree objective of the Paris Agreement, and obviously in the light of the US's withdrawal from the Paris Agreement, there's a shortfall at a national level in the US. So we're optimistic, though, that the private sector has a very important role to play going forward in the post-Paris world, and that there is significant demand for the private sector to play a role to help fill that ambition gap. But as you mentioned, the Paris Agreement framework does present question marks about how the voluntary market will operate and how that collective voluntary action can contribute to the objectives of the Paris Agreement. So that workshop we hosted was brainstorming a lot of these discussions, and we will be publishing a report from that workshop in the next week or so, which will be a summary of those discussions. And then later in the summer, ICROA will be publishing a straw man proposal on the future of the market. So we'll be outlining our views on how we think the market can operate post-2020. And we're looking to build a broad coalition in this area to try to define an industry viewpoint on the future of the market. So if anyone on the line is interested in our work in this area, do please get in touch, and you can also find further details of our workshop and the presentations from our workshop on our website at icroa.org.
Yeah, just to follow what Simon was saying, I think at this point there's a lot of ideas floating about, but I think one thing that's always very impressed me with the voluntary markets is just the level of passion and innovation that everyone has for these projects. So I would expect, I guess this is my personal view, but I would expect that there'd be some way voluntary offset participants figure out a way to continue operating even after countries start implementing their nationally determined contribution plans. And maybe I'll just do 2 more questions and then wrap this up because I think we're going over time a little bit. But so one question was for me about the methane category of transactions. What are the main sources, and is there not overlap with renewables? So the answer is, yeah, the categories are quite arbitrary. We just choose them based on where we think there's sort of interesting differences happening. So we have a methane category simply because we typically do see a lot of transactions that are sort of within just methane, and so we separated that from the renewables a number of years ago, I believe. But within that, most of the project types that were most of the offsets sold were from landfill methane project types, and most of those are actually from primarily from the U.S. And I think the reason why we see a lot of sales there is just that back in the day when the U.S. was considering a national cap and trade program, a bunch of landfill methane project developers thought that might be included. This was back, in the mid-2000s. Obviously, that did not come to pass because we've always had a very complicated relationship with climate change here in the U.S. So a lot of those project developers are active on the voluntary side still. And then moving on. So another question is, both Hassan and Brian mentioned land titling within their programs, and it would be interesting to know if there's been some specific trends in the voluntary carbon markets that can be attributed to land titling or land registration schemes. I'll let both of them speak to that as well. I don't know if we actually collect that information in terms of our reports, but I'd say anecdotally, yes, I think there has been, but perhaps Brian or Hassan has more concrete stories to tell about that.
Sure. Hassan, you want to go first? Or?
Sure. Just a clarification, we are not involved actively in any land titling. The land tenure across which we work is, in Zambia, the chiefdoms are quite a strong institution and are recognized. So the bulk of our work is in what are referred to as game management areas. Those are recognized within the Wildlife Act, so the law. And game management areas have a dual administration, partially under the Department of National Parks and Wildlife, and they also overlay chiefdoms, which have traditional authorities. The Lower Zambezi Red Plus project is on private land. We don't own it. We've entered into an agreement with the landowner, but we're not actively involved in any titling in community zones around any of these projects.
This is Brian. So yeah, the land ownership regime is very important to consider. For our 4 projects in Acre, they're different than what Hassan is working with. So we have 4 privately owned projects with communities living on these privately owned properties. The communities are sort of in this gray area where they do not technically have legal title to their land, but they do have some rights to the land because they've been living there for, say, more than 10 years. They've established a little household, some subsistence crops, raising some cattle. And so in large part, because of the voluntary carbon markets, because of designing these projects as VCS and CCB validated and verified forest carbon projects, the landowners are taking the necessary steps to officially grant land titles to all the communities living within their private properties, which is, I think, an amazing accomplishment and a trend that I'm seeing among other projects. And, fingers crossed, if the carbon markets completely fall apart and the prices just get too low and these projects are not able to continue onwards, I think one of the greatest legacies will be that regardless of the carbon markets falling apart, the communities will have title from now and into the future forever. Land title to their own lands will never be threatened with getting removed from their properties or whatever. So it's very important. I hope more projects are looking into how they can grant communities title if that is a possibility.
Great, thank you so much. I'm going to stop answering questions now because I think we're about 10 minutes over, but just wanted to reiterate to everyone, we have been recording this webinar. It will be up for probably in the next couple of days on our website, and the slides will also be up as well. Also, if anyone has any additional questions, I know I didn't reach all the questions. I'll be sharing these with the panelists, and we can reach back out to you after this. And if you have additional questions, please feel free to email me. My email is khamrick@ecosystemmarketplace.com. And I think with that, thank you again, and I hope everyone continues to find these reports valuable. So we expect I'll probably be in touch with a lot of you in the future about collecting data for next year. But thank you, and I don't know if Brian, Hassan, or Simon have any final words they want to say.
No, just thank you, everybody. It was a pleasure joining today's webinar.
Yeah, no, just thanks.
Likewise,
Kelley, and thanks everyone.
Yeah, also thanks, Kelley, for running the webinar today, and thanks to Hassan and Brian for giving their reflections on the report. Yeah, so thanks very much.
Great. All right. Well, thank you, everyone, and we'll have this up as soon as possible.
Great. Thanks again, Kelley.
Bye.
Bye-bye.